2/3 of Americans say it already feels like a recession. The government says we're fine. GDP is growing, unemployment is low, markets are near highs. So who's lying? Neither. And that's the problem. What you're feeling is real. It's called a silent recession. The economy grows on paper while your purchasing power gets destroyed. Your paycheck goes up, but your rent goes up more. You get a raise and somehow have less money. Your grocery bill is higher. Your insurance premiums went up. Your utilities cost more, but the government says inflation is under control. And there's data the government tracks but doesn't talk about. That explains exactly why it feels like we're already there. Data that shows the disconnect between Wall Street and Main Street has never been wider. Data that reveals why your personal economy feels broken even when the macro numbers look decent. Today I'm going to show you that data, explain why the traditional recession definition is broken, and walk through exactly how this silent recession works and where it's headed. What's up, guys? It's Tom here. If you've been following this channel, you know we've been ahead of this stuff consistently. We called the jobs overcount months before the BLS admitted they were off by hundreds of thousands of jobs. We flagged Bitcoin at maximum risk before it crashed hard. The defensive portfolio strategy we outlined has been quietly beating the market while everyone else got whipsawed by volatility. And right now, the recession model I track is sitting at 67 out of 100. That's pre-recession territory, up from the low 60s just weeks ago. Not because of any single dramatic event, but because the underlying economic data is telling a story that doesn't match the headlines you're seeing. This isn't doom porn. This isn't clickbait. This is pattern recognition based on data. Most people don't look at the same data that helped us stay ahead of the jobs revision, the crypto crash, and the market volatility we've seen. So let me break down what's actually happening beneath the surface, why it matters for your money, and what the probabilities look like going forward. Here's the thing about recessions. The official definition is 2 consecutive quarters of negative GDP growth, but that's an academic definition created decades ago when the economy was completely different. Back then, most people worked in manufacturing, most families had one income, and most purchases were necessities. That's not how you experience the economy today. You experience it through your rent check, your grocery bill, your gas tank, your 401k, your health insurance premiums. You experience it through whether you can afford to go out to dinner, take a vacation, or help your kids with college. And by those measures, the ones that actually matter to your daily life. We've been in recession conditions for over 2 years. Your real wages, that's your paycheck adjusted for inflation, have been declining for over 2 full years. The average worker is making significantly less in buying power than they were years ago. That's not a temporary blip from supply chain issues. That's a sustained trend of declining living standards. Meanwhile, the stuff you actually need to buy hasn't gotten cheaper. It's gotten dramatically more expensive and stayed there. Your rent didn't go up and then come back down. It went up. And that's your new baseline forever. Your car insurance didn't spike and then normalize. It spiked, and that's your new rate. So you're making less in real terms and paying more for everything essential. That's a personal recession, even if GDP technically grows, because corporate profits are up and government spending is high. This is why the polls are so disconnected from the economic data. People aren't stupid. They're accurately reporting their lived experience. The economy is growing, but they're not participating in that growth. The government publishes hundreds of economic indicators every month. The media reports on maybe a handful of them. The rest tell the real story. Housing affordability has collapsed. The median family cannot afford the median home with conventional financing. We haven't been this locked out of home ownership in decades. Back then, mortgage rates were higher, but houses were much cheaper relative to income. The math is actually worse now. Small business confidence is at multi-year lows and falling. These are the companies that employ nearly half of Americans. They're not expanding, they're not hiring, and they're not optimistic about the next 6 months. When small businesses lose confidence, layoffs follow shortly after. Consumer debt-to-income ratios are approaching crisis levels, but with a crucial difference. Years ago, most debt was mortgages at reasonable rates. Today, it's credit cards at crushing interest rates and auto loans that are strangling budgets. People are borrowing to maintain their standard of living, not to build wealth. Credit card delinquencies among younger workers are soaring. Continuing unemployment claims are rising steadily. This isn't the headline unemployment rate that everyone talks about. This is the number of people who are unemployed and staying unemployed for multiple weeks. It measures how hard it is to find a new job once you lose one. When this number rises, it means the job market is freezing up. And here's the big one. Job creation has essentially stalled. We're running at half the pace we need just to keep up with population growth. That's stall speed for the labor market. The job openings rate has collapsed. There are fewer opportunities, more competition for each opening, and longer time to hire for companies that are still hiring. If you're looking for work right now, you're experiencing this directly. But there's another layer to this that's harder to quantify but just as important. It's not just the math, it's the psychology, it's the collective mood shift that happens when enough people start feeling economic pressure at the same time. When you see layoffs in your industry, you start spending like you might be next. You postpone the vacation, skip the restaurant, buy the generic brand. When your neighbor can't afford their mortgage payment, you start questioning whether your own job is secure. When everyone you know is talking about cutting back, you cut back too, even if your personal situation is still okay. That's happening right now across multiple demographics simultaneously. Consumer sentiment surveys show people are worried and pulling back spending in discretionary categories. They're not buying cars unless theirs breaks down completely. They're not upgrading phones unless the old one stops working. They're not taking vacations. They're not renovating houses. They're not making major purchases. They're in psychological survival mode. And here's the crucial feedback loop. That behavior creates the recession it's trying to avoid. When everyone stops spending at the same time, businesses see revenue drop. When revenue drops, they cut costs. The first cost they cut is labor. When businesses stop hiring and start firing, people really do lose jobs. The fear becomes reality. This is why recessions often seem to come out of nowhere, even when the economic data shows they were building for months. People feel the psychological pressure before the statistical pressure shows up in official numbers. The model I track picks up on this stuff through market behavior indicators. Volatility has been elevated and persistent. Credit spreads are widening. Defensive sectors are outperforming growth sectors. Money is flowing into safe assets at record levels. All the early warning signs of a confidence crisis are flashing yellow. Oil prices are creeping higher despite weak global demand, which usually means supply disruptions or financial market stress. Gold is making new highs even with the dollar relatively strong. These are fear trades, not growth trades. So here's how this plays out. Based on the data and the model, there are really three distinct paths from where we are today. Path 1 is the soft landing scenario. The Fed manages to get inflation down to their target without breaking the labor market. Real wages start growing again as wage growth outpaces price growth. Housing becomes affordable again as either prices moderate or incomes catch up. Credit conditions ease, small businesses regain confidence and start hiring. The silent recession ends without becoming an official recession. Consumer sentiment rebounds and spending normalizes. This is the best case scenario, and it's what the Fed is actively trying to engineer. The probability of this path has been declining, but it's still possible if everything goes right. You'd need inflation to keep falling, the job market to stabilize without major layoffs, and consumer psychology to improve. That's a lot of variables that all need to align. Path 2 is the muddle-through scenario. We stay in this weird zone where the economy technically grows, but nobody feels good about it. GDP stays barely positive, but real wages stay flat or decline slightly. Housing remains expensive relative to incomes, credit stays tight, consumer sentiment stays low, business investment stays weak. The silent recession becomes permanent. Not terrible enough to trigger policy responses, but not good enough for people to feel optimistic about their financial future. This is probably the most likely scenario based on current trajectories. It's essentially what Japan experienced for much of recent decades. Low growth, low inflation, low confidence, but no official recession. Path 3 is the full recession scenario something breaks. The labor market cracks and unemployment spikes meaningfully. Businesses start failing in large numbers. Consumer spending drops sharply. The financial system experiences stress. The silent recession becomes loud and official. This could be triggered by a major layoff announcement from a big employer, a regional banking crisis, a geopolitical shock that spikes energy prices, or just the cumulative effect of declining confidence reaching a tipping point. Once unemployment starts rising quickly, the psychology shifts and the downturn accelerates. Right now, the forecast model is showing Path 2 as most likely. Path 1 is declining in probability. Path 3 is rising steadily. The key indicators to watch are continuing unemployment claims, small business hiring intentions, and consumer credit delinquencies. If those three all deteriorate simultaneously over the next couple months, Path 3 becomes the most probable outcome. So what does this actually mean for your money and your financial decisions? If you're sitting in index funds thinking you're safely diversified, you're not diversified, you're concentrated. The biggest stocks make up a massive portion of the major indices. When sentiment shifts and people start selling, those high multiple growth names get hit hardest. We saw this when the Nasdaq dropped dramatically while defensive sectors held up much better. If you're carrying credit card debt at crushing interest rates while your real wages are declining, that's a mathematical problem that doesn't fix itself. Every month you don't pay it off, you're getting objectively poorer in a silent recession environment. That debt becomes an anchor that drags down your financial flexibility. If you're thinking about buying a house, the affordability math is fundamentally broken. Median home prices require an unsustainable portion of median household income to service with conventional financing. That gap has to close somehow. Either prices come down, rates come down, or incomes go up substantially. Pick one because the current situation isn't sustainable. If you're worried about your job security, trust that instinct. The data supports your concern. Job creation has essentially stalled. Continuing claims are rising, and small businesses aren't hiring. If your industry is already showing weakness, it's likely to get weaker before it gets better. Having months of expenses in cash isn't paranoid, it's prudent. If you're close to retirement, sequence of returns risk is elevated. Drawing down a portfolio in the early stages of a bear market can permanently impair your long-term financial security. Having years of expenses in cash or short-term bonds gives you flexibility to ride out volatility without selling equities at the bottom. The key is positioning for the most likely scenario while protecting against the worst-case scenario. That means maintaining liquidity, reducing concentration risk, and avoiding leverage in an environment where credit conditions are tightening. And look, I get that none of this makes it easier if you're already struggling financially. Charts and data and recession probabilities don't pay your bills. Economic analysis doesn't fix your personal situation or make your rent more affordable. But knowing what's actually happening is better than reading headlines that tell you everything is fine when your lived experience says otherwise. You're not crazy, you're not imagining it. The disconnect between the official data and your personal reality is real, and there are structural reasons why it's happening. Understanding that this is a systemic issue, not a personal failure, can at least help you make better decisions about the things you can control. Bottom line, the silent recession is real and measurable. 2/3 of Americans feel it because it's actually happening to them. Real wages declining for years, essential costs up dramatically and staying there, debt levels rising, job creation stalled at half the pace needed for a healthy economy. The recession model reads 67 out of 100 and rising. That's pre-recession territory with momentum in the wrong direction. I remain defensively positioned. Heavy cash allocation, reduced equity exposure, focus on dividend-paying stocks and defensive sectors. It's the same posture I've held for months, and it's outperformed the broader market while providing much better downside protection. I'm not changing that allocation until the underlying data changes. The next major catalyst to watch is the upcoming jobs report. If job creation drops below critical levels, that's officially recession territory for the labor market. The model would likely jump higher, and path 3 becomes the most probable outcome. If you want to track this stuff in real time and see exactly what the model is seeing, I built a full dashboard at recessionistpro.com, dozens of economic indicators updated in real time, probability forecasts, sector allocation recommendations, and alerts when key thresholds are crossed. Next week, I'll be breaking down the specific defensive positioning strategies that have been working in this environment and why traditional diversification isn't enough when correlations spike during stress periods.